Good morning, everyone. Tushar, thank you for kicking us all off. And I'm really excited to be here. As you can all tell, we're really excited about crypto exchanges and where they're going. And so this morning, we're going to talk about kind of our evolving views in that space. As Tushar alluded to, we've been thinking a lot about crypto exchanges, and that thinking has kind of continued to evolve over the last year. We started off earlier this year in February by publishing a big paper on Binance, and that really kind of woke up the market's attention to the opportunity for crypto exchanges. And then just last week, I published an essay called Crypto Exchanges, or about crypto exchanges. And actually, just this morning, we published another paper on Binance. And so we've kind of continued to evolve our thinking. And what we've noticed is that the crypto exchange space is kind of merging with some of the other broader trends that are happening in technology and fintech more broadly, and that those really hadn't been explored by a lot of the thought leaders in the space. And people were still kind of pigeonholing different concepts, even though we're seeing a lot of interesting trends converge. And so this morning, what I'm going to do is share our expanded views on how we think this space is evolving and how we see crypto exchanges intersecting with some of the other big trends in fintech and technology more broadly. So there's going to be 4 major sections in this presentation. The first part, I'm going to talk about trust, and that's going to just be basically a recap of kind of our open finance thesis that we laid out 6 months ago at our last summit. Second part of the presentation is going to be talking about NeoBanks, how to think about them, what they are, how they've been evolving over the last few years. Third, I'm going to talk about crypto exchanges and how they have a really unique position to be the next generation neobanks. And then fourth, I'm going to talk about decentralization, how and why these companies should decentralize, why they shouldn't, and then talk about the implications on our portfolio. So let's jump in. At our last summit 6 months ago, I gave our first kind of big thesis on how we think crypto is going to evolve, and I talked about our first big thesis, which was what we call open finance. And in that presentation, I made a relatively bold statement that trust is the foundation on top of which all financial services are built. So let's kind of unpack that and understand what that means to provide some context for the rest of this presentation. Today, if you want, let's say, simple banking services, you go to the bank, you deposit some cash, the bank stores your cash, you get some interest on that cash. You get interest because the bank is loaning that out to someone else who wants to borrow it on the other end. The bank takes the spread. Now, the key that makes all of this work is that you are trusting the bank, right? You are taking counterparty risk on the bank. In the US, we happen to have the FDIC. They do insure things up to $250K, but you are still fundamentally taking counterparty risk on the bank. If you live in a place that's not quite, doesn't have the same type of trusted institutions, you don't have necessarily that same luxury. So kind of the most simple manifestation of the open finance thesis can be seen in a protocol called Compound that we think is super interesting. Compound is just a protocol that enables money markets. It enables you to deposit your capital into this contract. This contract, then anyone who wants to borrow capital against it can borrow out of that contract. This sounds basically what I described on the last slide. The difference is here is that you are not taking any form of counterparty risk. There is no way the Compound protocol can go under. There's no way, you don't have to worry about the FDIC because all of this just runs in code. And so this is kind of like the most basic manifestation of open finance. And we think this is a really fundamental primitive that's going to enable a lot of people to get financial services in the coming years. So at our last summit, I took this idea further and talked about how we can think about open finance as not just a single simple contract like Compound, but to think of this as a series of open and modular trust minimized contracts. And I talked about how you can recombine these contracts together to produce different types of higher level protocols, and then you can even build higher level applications, businesses, and services on top of those protocols. And so you can kind of mix and match these things like Legos, right? In computer science, we like to call this modular or modularity. And so this is kind of like the state of the art in open finance. There's like a whole wave of companies and protocol teams in the space building these things, and that's kind of evolved really in a fast way over the last 6 months. Now I'm going to pause and we're going to switch gears and talk about kind of traditional fintech and tech companies for a second. What's really important to note is that both the crypto people building these open finance things and the tech people and fintech people building traditional financial services really have the same ultimate end goal. Their goal is to provide financial services to the people who need them and to do that in the most effective, cost-effective way possible, both in form of underwriting and in form of accessing these people. Okay, so let's talk about neobanks. Here are 4 of the better known neobanks, Revolut, SoFi, Robinhood, and Betterment. All of these companies were founded in the last 10 years or so. When I use the term neobank, what exactly does that mean? Well, these are companies that recognize that traditional banks were underserving certain types of customers who had very specific demands. And so each of them got started off by focusing on a very small niche of the market and offering financial services to them that were 10x better than traditional banks did. So Revolut is kind of the poster child of like the modern internet, modern mobile banking in Europe, and they've kind of become the flagship neobank in Europe. SoFi recognized that traditional credit scoring was based on looking at historical records, and that for, let's say, students like engineers and doctors, right, that credit model was broken because those were people who were likely to have high future income but currently had no data to substantiate that. And so SoFi kind of changed how to think student loan lending. Robinhood disrupted the entire kind of business and payment model in equity brokerage. And actually we've seen in the last couple months, Schwab, Fidelity, and everyone else have cut their fees to zero as a direct response to Robinhood. And then Betterment is really kind of changing financial services and financial advisory by kind of thinking about a whole new model of thinking about debt and equity allocations in your personal portfolio. Now, what's really interesting about each of these companies is that they all started off with these very specific niches, but they've all started to expand into adjacent areas. They have a well-known, well-defined customer base, and they have a good relationship there, and they're offering them adjacent services. So for example, Robinhood started off with stocks. They now offer crypto trading, and they just started rolling out checking accounts. Betterment just started rolling out checking accounts. SoFi offers crypto, they offer equity, they offer all kinds of investment products through their single banking interface. And so that's kind of been this trend that's happening for the last 10 years or so. Now, what's really interesting as we think about kind of these next-gen banks is that we started to see a new kind of neobank emerge just in the last 12 months or so, and that's in the form of traditional tech companies that were not in financial services at all. So let me give you a few examples. T-Mobile announced a few months ago a new initiative called TMobile Money. The service is actually a pretty vanilla banking service. Checking account, debit card, ATM access. Nothing fancy. Why is T-Mobile doing, and like T-Mobile's not building any of the infrastructure on the back. They're using other service providers and building on top of other infrastructure. So they're not building the banking infrastructure themselves. So what is T-Mobile doing? Why are they doing this? Well, T-Mobile has about 80 million customers today, and a lot of those people are on prepaid plans. The kinds of people who are on, a lot of the reason people are on prepaid plans is because they don't have credit, they don't have a good bank account. And so that's why they use prepaid plans, because to have a postpaid plan, which most of you in this room have postpaid plans, you have to have credit and a bank account. And so T-Mobile's hypothesis here is one of access. They say, look, we know who these people are who don't have good credit and don't have good financial services. We live in their phones, and we have direct lines of communication to these people and can offer them novel financial services in a way that was never before possible. Next, let's think about Uber. So just a few weeks ago, Uber announced a new service called Uber Money. While there are some elements for riders, the actually more interesting thing to think about is drivers. Uber has more than 1 million drivers around the world today, and they've started to think about how can they offer better financial services to their drivers. What's really interesting about Uber is that Uber has the best data you could imagine on how to think about a driver's income. Uber actually started down the financial services path a few years ago when they started working on leasing for cars. Right? So Uber now has programs, or if you're a driver, they will lease you a car, and they'll say if you drive X number of rides per week or Y number of hours, like the lease is covered. And so Uber, this is kind of the next step in the evolution of Uber's financial services, where you can imagine Uber going to a driver and saying, hey, do you need a loan? You've got Christmas, family emergency, whatever it is that's happening in your life, we can offer you credit, and then we will help you understand when and how you should drive your car to maximize your income to pay back that loan in the most cost-effective way possible. And this is only possible because of Uber's unique position and relationship with their drivers. Next, let's think about Apple. So Apple started, this is the largest company in the world, most profitable company in the world. They, a few years ago, rolled out Apple Pay, and then just over the last few months, started rolling out Apple Card. Well, why is Apple doing this, right? This is the company in the business of selling you widgets. So what are they doing with financial services? And Apple, broadly speaking, has kind of two big goals over time. The first is they want to aggregate all of your spending data in one place so that they can ultimately leverage that. And the second is they realize is that because they are the makers of iOS, they have a privileged place in your phone. They have access to the lock screen in unique ways, the settings, all of these things, and so they can give themselves privileged access, whereas Chase or Bank of America or any other traditional fintech company can't. And so they want to use that as a leverage point to aggregate your financial services there. And ultimately, they want to be able to leverage that data and be a trusted brand for consumers over time. And then, of course, the 800-pound gorilla in the room is Facebook with Libra. Now, we should think, why is Facebook doing this? They've talked about banking the unbanked and kind of some other broad, noble claims, but we should actually think very seriously. This is a product that has thus far generated zero revenue for them. It's generated a lot of bad press, a lot of headache. Mark Zuckerberg had to fly across the country so that congressmen can berate him, right? Like, why is Facebook going through all of this energy and headache? And the reason is because Facebook actually believes they are the best positioned company in the world to offer financial services at a level of scale that is simply unprecedented. Right? That is their big motivation, and that's what they're going for. Now, Facebook has a logistical problem, and that's that they have 2.5 billion customers across 200 countries. Those people are then spread across thousands of jurisdictions in the form of states, provinces, and cities, and all of which have localized regulations. And on top of that, all of those regulations are changing as these places evolve. And so Facebook tried to solve this problem. They tried to hook up into a bunch of different banks all around the world, and what they realized is that it was actually impossible to deliver financial services at the billion-person scale. And so Libra is their solution to this problem. They said, hey, what if we can create an open financial system with a single API that anyone can plug into? And that's how they looked at using Bitcoin. They ultimately determined that Bitcoin technically had some shortcomings that couldn't get them to the billion-person scale, and that's why they're working on Libra. Okay, so with that context on kind of neobanking over the last few years, I want to talk about what we can kind of the trend here pretty clearly is that a lot of big tech companies are becoming neobanks. And Google and Amazon and all these guys, you'll expect over the next few years to see them all do similar initiatives with kind of their own unique lens and vantage point. What they're all realizing is that they have unique access and insights and data about their customers, and that they can offer them really fundamentally unique financial services in a way that wasn't possible before. And so the battleground for neobanking is just going to become exponentially more competitive over the coming decade. And that's a really exciting opportunity. All right, so with that context, let's turn to crypto exchanges. Crypto exchanges today serve tens of millions of people all over the world, maybe upwards of 100. And they're actually starting to act as banks too. Just a few weeks ago, Binance announced that you will be able to hook up a debit card to your Binance account and treat your Binance account as a checking account effectively and spend directly out of it. This is really the first step on their journey to becoming a type of a traditional bank. But again, people today just think of them as an exchange. So the argument I'm going to make today is that these crypto exchanges have 3 structural advantages that traditional companies do not have on their ambition to become global neobanks. The first is scale, the second is speed, and the third is network effects in the form of liquidity across all of their products. So let's jump into number 1. Let's talk about scale. Simply put, crypto is the payment rails that allows crypto exchanges to offer financial services to billions of people around the world. Again, as I just talked about with Facebook, this is precisely Facebook's motivation for doing Libra. All the crypto exchanges today already inherit this for free, right? Because this is all the rails they're built on top of. Now, just to be clear, I want to highlight some of the other key traits that crypto provides that really make this global payment rail system possible. The first is no counterparty risk, right? Crypto assets are bearer assets, and consumers own them directly. And the ultimate goal here is for financial services providers to be able to offer trust minimized or trust-free services to their customers around the world. This is basically the open finance thesis that I presented earlier, and there's a lot of entrepreneurs in the space today building these kind of trust minimized contracts. The second is that you want open, permissionless, censorship-resistant payment rails. This is what crypto gives you, where you sign a message, send it out to the network, and it gets propagated. Anyone can access the network, both on the supply side, and anyone can send a message on the demand side, so no one can be encumbered. And then the third, and the most important, is the idea of public global APIs. Again, this comes back to Facebook's reasoning. Hooking up to thousands of localized financial systems is effectively impossible. And so you want a global open API that anyone can hook up to. And that's a single logical interface for developers to be able to build on top of. Again, the internet here is a helpful analogy. If you build any form of software today and you want to send packets of data from point A to point B, you just say, please send data to this IP address, and the internet takes care of it for you. No such analogous concept exists in money today. What crypto provides is the way you can say, please send money from point A to point B, and you know that it will go through anywhere in the world. The second structural advantage is speed. This is a set of products that Binance rolled out in just Q3 of 2019 alone. Now, let's think about, I don't have time to talk about all of these different products, but I want to just highlight 3 of them. They launched a futures exchange, options exchange, and margin trading in Q3. Just to give you a sense for what that means, let's compare it to some traditional fintech companies. Robinhood, which is widely considered one of the most innovative, forward-thinking companies in traditional fintech, it took them 3 years after rolling out equity trading to launch margin, just margin trading on top of that. It took them another 2 years to add checking accounts. PayPal, for years after Venmo came out, did not offer a directly competitive service that was usable. And it's been more than 10 years since the iPhone has been out, and probably still for most of you, sending money out of your checking account is still substantially harder than it is to use Venmo or PayPal. And it's been 10 years since we've had smartphones in our pockets, right? And so that's the kind of time scale on which traditional fintech operates. These companies operate on the scale of months and years. Crypto exchanges operate on the time scale of days and weeks. And so Binance rolled out all of these different products to more than 20 million customers across more than 50 countries in a 90-day period, right? This level of speed is like orders of magnitude above and beyond what traditional fintech companies can do. And this is only possible because of the structural advantages crypto provides. When you make money transmission, just an open API, you can move and build at software speed. And that the level of delta between traditional and crypto companies is really just incredible. Okay, and then the third structural advantage these exchanges have is a really strong network effect in the form of liquidity. And what's really interesting about liquidity is it's not just a spot exchange where you're just trading Bitcoin for USD or Bitcoin for RMB. But you have all of these different types of financial products, and they're all feeding into one kind of big liquidity engine. So let me give you kind of an example. If you're just a consumer, you've got a debit card hooked up to your Binance account, right? Let's say you've got some Bitcoin in there, and you want to spend for some local fiat currency. When you swipe the card, the system is going to trade some Bitcoin for some fiat, and send the fiat out wherever it needs to go. That's obviously going to create liquidity in the system. That liquidity, right, because it's coming from retail going to just buy some goods and services, will be handed off to some sort of HFT market maker, and they can quote a super tight spread. And that allows market makers to offer tighter spreads. Because market makers can offer tighter spreads, that's going to attract bigger, more institutional hedge funds into that area, who want to be able to take directional risk up and down. And ultimately, if those guys get in the space, they're going to want to take on leverage, and they're going to need to margin their products. And so they're going to lend and borrow from the consumers on those platforms. And so you get this like big global, that's just kind of one very rudimentary example, but you get this really strong network effect that feeds between these different products. And this is something that the crypto exchanges have in a unique way that really no other companies have in the world. And they're doing this today on the order of $10 billion plus of liquidity per day. And that's growing pretty quickly. Okay, so I've made kind of the broad bull case for crypto exchanges as the next gen neobanks. But the big problem with the thesis that I just presented, very obviously, is that none of these crypto exchanges are really decentralized. They don't really look like the traditional open finance things that I talked about at the beginning of this presentation. And so the kind of big question is, well, why would these exchanges bother to decentralize? What is their motivation? And I'd actually make the argument that they have to. And the reason is because as they offer more and more financial services, they're going to become more and more regulated as traditional fintechs. And that's going to ultimately be the bane of their existence. You're not going to get the speed advantages that you want under that kind of regulatory regime. Remember, the whole point of Libra, again, was to create an open money system that anyone can access. And yeah, while Libra V1 is permissioned, the plan is to decentralize this thing over time. Decentralization is the means to the end. It's the way to stay resilient in the face of uncertainty and what's going to evolve in a fast space. And again, as Tushar indicated this morning, the pace of innovation and movement is just starting to pick up. What's really interesting about this is that we already have a lot of indications that the exchange CEOs are thinking about this in a deep way. This is a tweet from CZ. He's the founder of Binance. And he actually acknowledged that the end state of Binance is that Binance Inc. is no longer a thing, but that all of the value in this ecosystem accrues to the BNB token. He's in a particularly unique situation to recognize this because of the history of Binance. Binance launched in July of 2017 in the middle of the ICO mania. 60 days later, the Chinese government banned crypto to fiat trading. He ended up moving the company 5 times to Hong Kong, Singapore, and ultimately to Malta, and that's where they're domiciled today. And they went through this re-domiciling and moving their people, their staff, their legal operations in the middle of the craziest explosion of all time, right, in the back half of 2017. And so this was a really deep, informative experience for Binance. And so like this kind of understanding the need to be decentralized is really baked into their DNA in a way that very few other companies have experienced. They realized that the only way to produce something that's going to last forever is to decentralize it. And they've already felt that pain in a very real way. So decentralization is not binary. It's a spectrum. And so let's kind of think about some of just the major ways in which these folks can try and decentralize themselves. The first, as I just stated, is kind of just decentralizing through regulatory arbitrage. So if we look at Binance today, Binance is domiciled legally in Malta. Most of the staff is in Shanghai. They've received investment from the Singaporean Sovereign Wealth Fund, and they have a lot of employees in Japan, London, and they have subsidiaries all over the world. It's a very structurally decentralized organization. This is, by the way, the same is true for most of the major offshore crypto exchanges. They may have a hub, but they have a huge percentage of their staff are spread all over the world. They all recognize the need to have their staff, their servers, their infrastructure, all be as decentralized as possible. And so that's already started in a very meaningful way. The next is peer-to-peer trading. So in the wake of in 2017, when the Chinese government banned crypto to fiat trading, Huobi, which was one of the larger Chinese exchanges, they rolled out an app for peer-to-peer trading. And it's in the App Store today, and it trades probably $100 million plus per day. And Binance actually just rolled out something else that's similar, where this is an application that's truly peer-to-peer. The exchange is not in the middle. What's really interesting about this is that these volumes are unreported because they're peer-to-peer. The trades aren't happening on a centralized exchange. And so there's effectively no press and media coverage about this. There are millions of people today onboarding and offboarding from crypto using these peer-to-peer exchanges, and there's effectively no press coverage. But we think this is a really big deal, and again, this trend and wave is just getting started. We've been talking to these exchanges and understanding how they're evolving their roadmaps, and one of the next logical things is going to be peer-to-peer lending. This would look something like the Compound protocol that I highlighted earlier, but we know this is coming in the not too distant future. And all of this is ultimately building in pursuit of the ultimate goal, which is non-custodial peer-to-peer trading, right? And that's where they're all working towards. The tech isn't there to do that yet at scale, but they're all working towards it, and they all know they have to get there. So that's what they're working towards. Okay, so I'd like to conclude by talking about our portfolio and our theses. And I'd really like to talk about our theses in the context of what has changed and what hasn't. So let's start with what hasn't changed. In the last 6 months, the amount of capital being put to work in these open finance contracts, like the ones I highlighted at the beginning of this presentation, has about doubled from about 300 million to about 600 million over the last 6 months. So, more than 200% year-over-year growth rate. And that thesis of open financial contracts on blockchains has not changed at all. In fact, we can see continued growth of that in a very pure way. What has changed is how we're thinking about scale, right? Right now, we're thinking about how do we get from the status quo to some end state of the world. Today, open finance is operating at about the $1 billion level, plus or minus. We're thinking about how do we get from $1 billion to trillions. So we're talking 1,000x from where we are today. And as we've thought about scale, how do we get from here to there, we've increasingly come to the realization that the most likely path is that the exchanges that are today centralized are going to be the ones who push the ecosystem forward and get us there, and they're going to decentralize themselves along the way because they have to. And so in terms of our portfolio, that obviously means we're very long exchange tokens. We've spent a tremendous amount of time and energy over the last 6 to 9 months researching these organizations, understanding how they think, their org charts, with their products, their strengths, their weaknesses, and then building a portfolio accordingly. The other thing, though, we've really been investing then is understanding what are the key technologies that are going to need to become available for these exchanges to decentralize themselves. What are the scaling technologies, the key management technologies, the privacy technologies that you're going to need to make all of this decentralization stuff happen? And we've been investing deeply in those as well. And so that concludes my presentation this morning. Thank you all. We really appreciate you being here. Again, later today, we have Adam White, the COO of Bakkt, and Catherine Coley, the CEO of Binance. So we're really excited for you all to hear from their perspectives. Binance and Bakkt are obviously two very different organizations. This presentation was very focused on kind of consumer neobanking stuff. And Bakkt is going to be like a much more traditional exchange business. And so we're really excited for you all to hear these two folks coming from two very different backgrounds talk about their unique vantage points on the world. We are, of course, investors in Binance, and we are also actually investors in Bakkt as well. And so we're very excited to have Catherine and Adam with us later today. Thank you all.